Now, strong earnings, record prices for gold, Ben Bernanke's groundbreaking news conference, all making for a busy news week. Well, let's find out what all of this might mean for our future. My next guest is James Grant. He is the founder and editor of Grant's Interest Rate Observer, an independent journal covering the financial markets. He is also the author of the soon-to-be-released book entitled Mr. Speaker, The Life and Times of Thomas B. Reed, the man who broke the filibuster. Jim Grant, always great to be with you. Thanks so much for coming in. Before we get to Mr. Speaker and a little bit, I'm going to hold it up. Don't worry, we're going to plug it. But before we get to Mr. Speaker, I want to find out about another Mr. Speaker, Ben Bernanke, and his first ever news conference.
May I read something that he said?
Did he sign it?
Well, no. But
no,
it's not
come on. He wrote you a letter?
No, this is a part of the transcript.
All right,
and
go ahead.
I think it's important to get this out.
You're more than welcome, so go ahead.
It's true, he said, that we've used some different tools, but these tools are operating through financial conditions, and we have a lot of experience understanding how financial conditions, like interest rates and changes in stock prices and so on, how they affect the economy, including both growth and inflation. This man has no self-awareness.
Basically, he was saying, trust me.
I mean, are these the same people who saw nothing of our sorrows of 2008 and 9 until they were upon us? And he gets in front of the world and says, we know this stuff. This is really nothing different. I mean, it's quite remarkable. It's quite remarkable.
All right, so having said that it's quite remarkable, when you look at the alternative, in other words, what could he possibly have said? I got it wrong. We made a big mistake. Do you have any suggestions on how to fix this? What would be the alternative, really?
Well, I think that for the sake of mental hygiene, as well as for the sake of the integrity of markets, it's better if markets are not manipulated. And it's better if those who would manipulate them have the humility to admit that they, in the past, might have made one or two mistakes. That, to me, would be all to the good. And I don't think it would be such a humiliation for the fellow who said it. I think one would think rather more highly of him.
Right. People would say, all right, yeah, you're human. People do make mistakes.
Yeah, I mean, I don't think he would insist that he's not human, although from time to time one wonders. He is indeed a fallen mortal like the rest of us, but my goodness, he gets in front of a television and he says that we know how this works. We know how the stock market works. Nobody knows how the stock market works.
Even the stock market doesn't know how the stock market really works.
Especially Mr. Market is in the dark most of the time. I don't know. I thought it was an extraordinary moment that we deserved. It should be lingered over from time.
All right. Well, let's linger over it, but in the context of what is happening right now with the U.S. dollar, with the price of gold, and with low interest rates. Have you ever seen this confluence?
I can hardly see these interest rates. I'm not getting any younger, and I have difficulty seeing nothing.
Get you that microscope.
Yeah. Well, zero interest rates are, of course, a great vehicle for the distortion of values. A really fine investor named Seth Klarman at a recent Grant's event said that Ben Bernanke is kind of the anti-Graham. Graham talked about value, and Ben Bernanke talks about price. He talks about these indices, like the Russell's making a new high. But nothing about value, and that is the great trap for us civilians, for us investors. The Fed is happy just to levitate asset values. I wish somebody had asked him yesterday, what happens when it's down 20% the next time? What happens to the people whom you invited in with 0% rates? What duty or obligation does the Fed owe them, and will there be a QE3? Yes. There will be.
Well, you indeed, and I've read in one of the most recent issues of Grant's Interest Rate Observer, where you talk about the idea that with these incredible low interest rates, what the Federal Reserve has basically done is decimated the savings of millions of Americans.
Yeah, the poor savers starve, and the already corpulent speculators get fatter. It doesn't seem quite fair.
Thrift and prudence don't have any place in this economy, it seems.
I think that their own reward.
Well said. All right, so having said that, what about gold at $1,500 an ounce? I mean, is there enough gold in the world if we were to return to some kind of gold standard? I know you're going to be having a debate next week about whether we're supposed to be linking money.
I'm all in favor of a new gold standard, not least because it is a highly sophisticated information system. The Ben Bernanke system of command and control is kind of a brutal analog system, it seems to me. They get information and they collect it and they make these judgments based upon their models and preconceptions. That to me is kind of early 20th century. The gold standard, which flourished in the 19th century, is paradoxically rather 21st century because it is semi-automatic and it functions based upon the price mechanism. So the Fed is imposing its will, and the gold standard acts upon the price signals of myriad people and actors in the marketplace.
What would you say, though, to those who look at the actual production of gold on an annual basis or the amount of gold in storage and say, you know what, there's not really enough gold out there to back any kind of financial system that would include growth?
I would say there is.
Okay, there is. You think there is?
So the stock of gold probably includes all of Cleopatra's bangles. The stuff is it's eternal. So the average annual increase to the existing stock of gold is of no real consequence to that stock because it's like 2%, about, say 2% a year over the long sweep of time, which is about the growth in the world's population. So it seems to me that a monetary medium that grows about in lockstep with population is a pretty good start. The gold standard is not a panacea, but it is probably the least imperfect system we have known, as opposed to the systems we have imagined in the seminar rooms of Yale and Cambridge and Oxford. It's different.
And we'll also toss. I was going to say we're also tossing Princeton in homage to Ben Bernanke.
I've heard of
You've
that.
Heard of that place? All right. We're going to. Jim Grant, I'm holding up the book. Why a book on Thomas B. Reed?
He is a fascinating figure who lived in a time a lot like ours. It was a time of terrific monetary turmoil.
1890. He was Speaker of the House of Representatives, 1890 twice, right?
3 times, right?
Yeah.
And he was a great Republican speaker who succeeded in breaking the logjam of parliamentary obstruction in the House of Representatives. And the wonderful irony of his life, or at least the notable irony of his life, is that having broken it, what he got was the first inkling of the great Leviathan we call the federal monster.
Big government.
Big government, yeah. So what he wanted throughout his entire political career was modernity. He was all in favor of progress. He loved the idea of the telephone, of the spread of electricity. He was a dinner partner of Thomas Edison. You know, he was so much in the van of 19th century thinking and of progress, and he thought that Congress should be a part, at least it shouldn't obstruct it, and it should be able to do a good day's business without people sitting around and making, these artificial parliamentary maneuvers that would obstruct every single piece of legislation.
Explain this whole idea of a quorum for those that haven't had the chance to take a look at the book.
The Constitution says that you must have a certain minimum number of people in the House to do business. And what it doesn't say is those people have to be there, but they also do they have to speak? Well, if they don't speak, are they there? And the tradition was, the usage was that people who showed up physically, if they didn't answer their names to a roll call, were not there politically. They were not there in a parliamentary way. Therefore, there was no quorum. So people could just sit in their hands and close their lips, and business would come to a standstill. Well, Reed thought this was an abomination, and he single-handedly broke that through a very dramatic episode in the floor of the House. But what he got was what he thought he wanted. And like so many of us, having gotten what he thought he wanted, he realized he didn't quite want it so much. What he got was progress in the shape of a much more active federal government, including a government that instituted a war of choice with Spain, which led him to resign in a certain amount of disgust.
Now, one of his close friends, at least for a certain part of his life, was Teddy Roosevelt, right?
Yeah.
Because Teddy Roosevelt, Republican adventure president, was really not in tune with what Reed was all about.
Well, Teddy Roosevelt worshipped Reed. Reed was a wonderful, facile writer. Roosevelt, of course, was our first professional author president. I guess he was first. Anyway, Roosevelt was a professional author. He thought Reed's style was divine, and he told him so at every occasion. And Reed was a few years older, and he looked up to him as a mentor. But Reed was an ironist, and he was basically a fellow who wanted individuals to be free to live their lives, and Teddy Roosevelt was this most muscular of statists And Teddy Roosevelt was, of course, in the van of the great progressive movement that would rearrange the relationship between the individual and the American government. Reed wanted none of that. And it was a great trial to Reed to see Teddy Roosevelt in action.
What did you learn from writing the book that connects his time in the 1890s with our time today?
I was struck by how little has changed and how much has changed in the world of finance. People under stress in situations involving financial loss, nothing has changed in the least. Sweat through the same pores, die the same numbers of thousands of deaths, it's all the same. And similarly, in the realm of monetary organization, great debates then and now over the nature of the dollar, over the nature of the control of the dollar. Then, of course I say, as if you read the book already, then people decided that what they wanted was, as it were, a yardstick that was 36 inches. That's it. Not 34 inches in some cycles, not 38, not 32, 36. Now, under the PhD standard, so that was the gold standard. Now we've adopted the PhD standard, in which our masters at the Fed adopt a yardstick of variable length depending on their view of the cycle.
No more bimetallism in the U.S. government right? No more silver.
No more metalism.
Right, no more metalism, right? No more, where the man is not going to be crucified on a cross of
man's going to be crucified on a stack of PhD dissertations. That was going to be crucified, which, by the way, is a horrible death.
It sounds that way. Well, I mean, all right, so having put the book to bed, what's the future?
I want to wake up, by the way.
Well, the book is going to wake up because people are going to read it. But I mean, having written it, then what do you see for the future of at least our own financial system here? More gold? Should we buy gold? $1,500 an ounce.
Well, the investment question is different from the monetary organization question. And the investment question, my formulation on gold is simple. The PE ratio is the same as it was at $290 an ounce. It's just as overvalued, just as undervalued. The value is indeterminate. My notion of the value is 1 divided by n, n being the world's view of the efficacy and plausibility of this regime we have. Can it possibly work? The smaller n gets, the bigger the gold price gets.
We have to leave it there. I want to thank you very much, James Grant, the author of Mr. Speaker. Always a pleasure, always enlightening.